Hi, this is Mark Helwig. Welcome to our series here talking about the specific design attributes and concepts behind the value charts trading tools, and also working our way up to specific trading situations where these tools can be applied in the markets. So we want to start out in this first video basically talking about just the very basic thought process behind the design that was used to create the value charts trading tools. Let's take a look at an example here using a bar chart, a traditional bar chart applied to the euro currency futures market. Now, in this example, we can see that the price bars are green, obviously, and that all the prices are plotted with respect to absolute zero. So this is normal. Every traditional price chart, whether it's open, high, low, close bars or candlestick bars, are always plotted with respect to zero. They're designed to do that. So they're always, whenever we talk about price or display price in any chart, we're really looking to do that with respect to zero. Now, these traditional price charts are beneficial or can be used to detect shorter term or longer term price trends. They can be used to detect important support or resistance levels, or potentially define historical trading ranges, just to name a few benefits there. Now, if we were interested in trying to understand value, what would we do? One thing to do would be to create a simple moving average of median prices. What does that mean? Median prices are essentially, a median price level is the high plus the low of any given price bar divided by 2. So it's finding the center location in any of these price bars would give us the median price. And then this black line we see displayed here is communicating a moving average of median prices. So this is a primitive definition of objective market valuation. Again, this is all being derived from the transactional price history we see as reflected through this traditional price chart. There's nothing, obviously, with this moving average that's being considered other than traditional or transactional price history. It's important to understand that. Okay, so whenever we talk about objective market valuation, we want the market to tell us what it thinks value is worth. Now, we don't care about, in this particular study, we're not talking about subjective valuation, which is the opinion of some analysts who 9 times out of 10 doesn't even trade the market that he or she is evaluating. So we want to know what the market thinks a market is worth. When I say the market, I mean the participants, buyers and sellers, what buyers have paid and what sellers have sold for. That is by far the best input when considering or determining the objective value for any market. So again, we're starting with value basics here, and in this example, we are just creating what we call a floating value axis, and this will serve as just a very primitive definition of objective market valuation. Now, if we take this one step further, the question then becomes, can we measure the degree that a market is overvalued or undervalued beyond this floating value axis? Now, the answer to that is yes. Now, we're going to talk about that in an upcoming video here, but the idea is we will define a floating value axis, nothing special or magical about that, but we're going to go on and start going further down the line in terms of creating a value framework or a definition of valuation for any exchange traded or OTC market. And we're going to do that by using this floating value axis as our reference level and then measuring deviations using a specialized price unit known as a dynamic volatility unit, which expands with increasing market volatility and contracts with decreasing market volatility. We're going to use that to actually measure deviations. And that's really the only way we can do that and maintain a value or overvalued state reference or undervalued state reference. So in the next video, we'll expand on this concept. Thanks for watching.